two, one. Thank you so much for coming to check out another episode of the Stashcast, where we have interesting conversations with interesting people focused on the world of commercial real estate and prop tech. The Stashcast is brought to you by Needle. What if you could use data and analytics to predict real estate transactions before they're going to occur? You can with Needle. Come check it out at needle, NEDL.us to learn more. All right, today I've got Brian Underdahl here with us. And Brian, why don't you give the people at home a little idea of who you are and what you do?
Yeah, thanks for having me on. So I am the Chief Analytics Officer for Nuvo Capital Partners. Nuvo is a multifamily owner-operator, primarily in the Sun Belt and Southeast. My primary role with them is doing market research. In fact, I'm very interested to hear more about Needle now that you mentioned that. But I handle the numbers on the back end to decide which markets we're going to go into, and then also serve on the investment committee. Nuvo is headed up by myself, our CEO, Stuart Keller, and our other partner, Lenny Bazana, handles capital markets.
Nice.
So we're actively acquiring assets in Sunbelt and Southeast, and our primary focus for the next 18 to 24 months is really in the rescue capital space, trying to help out sponsors that have properties that are struggling financially.
That is an appropriate space to be in. I would imagine that there's going to be some opportunities to be had in that space, especially in the markets that you're targeting. So what are your target markets?
Pretty broadly across the Sun Belt and Southeast. So as far as we've looked at some stuff in Phoenix also, but primarily Texas, Carolinas, Georgia, Florida. Those are probably our biggest focus right now.
Okay. So if you're in charge of like analytics for the firm, what are the things that you're targeting or looking at when you're evaluating either markets or opportunities?
Yeah, a lot of the standard stuff, population, migration patterns, employment, the percent of burdened households, those that are making less than 35% or spending, more than 35% on housing, just general health metrics of the economy or the local submarket to just give us a sense that, hey, this is solid fundamentally. And then we look into the property details.
Mm-hmm. So you're targeting the overall market first and then narrowing in on the opportunities from there.
That's right. And sometimes the tail wags the dog. Somebody will send us a property in a market that we haven't been in, and then we have to spend time digging into it. But primarily, we have the markets that we know that if something comes across, it's a lot easier because we just have to look at the property at that point.
Mm-hmm. That's interesting. Where are you getting your data from that you're evaluating?
It's usually sourced from Fred, the Federal Reserve of St. Louis. They have a lot of free data on there, and they have a really cool API where you can pull data directly into your spreadsheets and have it auto-populate and all that good stuff. And of course, Fred pulls from different sources themselves. So they're pulling from BLS and census and that sort of thing. And then we can it's a nice central location to get everything. Of course, we use CoStar because everyone does. And that's really good for the local submarket info. But at the county and city level, we use Fred primarily.
Mm-hmm. Yeah, that's one of the APIs that we're taking advantage of as well. Interesting. So then if you've got the macro kind of ironed out for the given markets that you're looking at, what are some of the tells for acquisition? Are you using the data to look at and target like particular acquisition opportunities, or these are the markets and submarkets we want to be in, and then let's go find what's there?
Yeah, so we're primarily focused on workforce housing. We do look at some newer construction, but because our strategy is really tailored towards rescue capital right now, a lot of the properties that we're looking at are Class B and C assets in the Sun Belt and Southeast. And so the market data that we look into is really geared towards those markets. So blue collar jobs, new employers coming to the market, what employment might be the single biggest thing for me, what the jobs outlook is, because quite frankly, people follow jobs and then find themselves in a city that they want to be in. So I don't know if that answered your question or not, but
yeah, that's fair. So when you say rescue capital, I feel like I have an idea of what that means, but it might mean something different to you and maybe to the audience as well, because it is a newer term given the run up that we've had over the past 10 years, 11 years. How would you define rescue capital?
Yeah, it's newer because it's not new, but it hasn't been used in a while, like you
Right.
said. Haven't needed it. So it's essentially, it comes in different forms, but I would define it as any capital that comes in to save or be a solution to a struggling property. Some people consider preferred equity as rescue capital. Some others are using it just for a rate cap extension or to refinance, or maybe to wait out the situation until the value add strategy gets executed. So you just need a little bit more runway there. But primarily we see it being used for like rate cap extensions or refinancing and additional capex. So there's the pref option or preferred equity option. We do something a little bit differently, wherein we actually are acquiring the properties outright and then including the sellers into the transaction so that they become a partner in the new transaction. Basically, they become an investor in our deal, and that allows them the opportunity to recoup some of the capital from the carry when we sell the property down the road.
Interesting. And does that kind of allow them to maybe save face with their investors if they've had to take a deal like this?
It has that effect. Yeah, that's one of the benefits, I would say, in that they're not realizing an immediate loss. They're still in the deal. There's still a chance to recoup the capital down the road. And it's sometimes a better option than a capital call, where the capital call might not even be enough capital to fix the problem. And that's where we can come in with more than enough capital to address the problems at hand and execute the value add strategy that was probably laid out beforehand and just couldn't get executed because of interest rates.
Yeah. So let's assume that you're coming in and you acquire the property, so you've effected a new transaction. Are you assuming the debt and then placing a new rate cap on that?
So that can work a number of ways. Because the property is struggling financially, a lot of times the occupancy is lower.
Mhm.
So you can't immediately change the loan structure to agency. It works out very well to assume the debt from, let's just say it's with a bridge lender. That's already in place. You can assume the debt and typically will pay it down as well. The lender really likes that. We're not assuming it at 95% LTV. We're actually paying it down to 65%, even 50% on the when we acquire the properties. To answer your question, most of the time, assuming the loan.
Mhm. Interesting. And so are the most common occurrences when you guys come in on a deal, is that when a sponsor were they just failing to execute or they ran out of time? Like wh-
Yeah.
why or how does somebody find themselves in a situation, whether it was their fault or not, needing to strike a deal with you guys?
Most of the time, or most of the opportunities that we see, or the struggling properties, they were purchased sometime in late 2020 to early 2022. So just pure bad timing on the acquisition, acquiring it right before interest rate hikes to the properties around 2021. So they probably had, well, they did have a value add strategy that they wanted to implement, but as soon as interest rates started going up so rapidly, lenders started holding back on some of the capex distributions to where they weren't able to execute the value add strategy. Their capex budget had to be diverted to debt service. And once that happens, it's just a vicious cycle
Yeah.
where now you don't have money to execute the plan, so you can't raise rents. As more and more of your NOI goes to your debt service, now you don't have property, or excuse me, now you don't have the capital to even complete work orders in some cases. Those start piling up. Then your property manager is getting upset if they're not getting what they need to keep the property in good shape. And then vendors sometimes don't get paid because there's not enough capital there. So now you might be struggling to bring in vendors to even fix pretty mundane issues on the property because they're concerned about getting paid. And so that's what I mean by vicious cycle or
Yeah.
spiral. It just it feeds off of itself. So what may have not even been at the fault of the sponsor at all initially just spirals out of control.
Yeah. Oh man, that's a no fun situation for somebody who finds themselves there. Are you finding that it is mostly inexperienced sponsors that you're finding opportunity with, or is it across the board?
It's a little bit across the board. We don't see much from the institutional side because, quite frankly, they have deep pockets and can just pay to fix these issues. So by default, it's sponsors that have not been in the space as long as others, because syndications just became very popular, especially over the last 5 years. And
Yeah.
so the majority, I would say, are probably within that under that 5 year mark as far as how long they've been operating.
Yeah, it seems a lot of people looked at real estate syndication and multifamily as a way to get rich quick over the past couple of years, and it seems like the chickens are coming home to roost.
I think there's some of that there for sure. And that if it's presented as get rich quick, I would say it's anything but that. But with that being said, if you've got a 3 or 4% acquisition fee, it feels pretty good getting that check the second you close on a property. And so to that extent, I think it's true. They were able to make a lot of money very quickly. But as far as operating an ongoing operation, that business model just drives new acquisitions.
Mhm.
So you're not as worried about the asset management because the real payday is on that acquisition or on the exit in this case. But a
Or
lot,
both. Yeah.
yeah, both.
Yeah, it seems like there are a lot of overnight experts in I'm going to teach a course, and then you'll hear on my side of things, you'll hear, yeah, my partners and I have 5,000 units. And then you dig a little bit, you scratch the surface a little bit, and it's actually your partner that does, and you just went to a course, um, and you're trying to get into it. And operations are that's the that's the tough part about multifamily, because you can't necessarily hire third-party property management is necessary, but it's a thankless task. You've got the owners on one side who want to maximize cash flow and keep expenses low while executing on the business plan. And then you have the tenants on the other side who are wanting work orders or to not pay their rent or whatever it is. And you, as the manager, just stuck in the middle. That's interesting.
Yeah, our CEO Stuart, he was in property management for years, and he's got lots of stories about very much what you're talking about there. Very helpful to have him overseeing that because he's been in asset management and property management, so he can bridge that gap that naturally exists between those two types of professionals.
Yeah, absolutely. So how did you get into your role? Were you an economist to start or an accountant? Tell me
Yeah,
about that.
yeah, I was actually coming out of undergrad, so this was back in 08, 09, which was a fun time to be starting your
Yeah,
career.
that's when I got started.
Perfect. Then I was in sales, financial services, insurance. Made a bit of a shift in 2016, 17. I went back to grad school for applied economics at Florida State, and that's where I met up with some guys at a hedge fund there, really great people. I still stay in touch with them. And they let me intern while I was in grad school and then later work with them. And we started a fund of funds investing passively in syndications and sponsors across the Sun Belt and Southeast. For the 6 or so years prior to joining up with Stuart and Lenny at Nuvo, my primary role was vetting sponsors to decide who we wanted to invest with. I actually know an awful lot of syndicators and sponsors myself, and I'll be meeting up with a bunch of them again soon at a conference. But that's where this whole idea for Rescue Capital came from. My old fund, we got some requests from deals we had previously underwritten to see if we would be interested in pref equity. Then the request became more than pref equity. It's, hey, do you want to, help us recap this? And we realized there's probably going to be a lot of those opportunities, but we weren't operators ourselves. We were investing passively. And that's where the idea to join up with Stu and Lenny came from. Stuart was one of the operators that we wanted to invest with at my old shop. Knew him very well, knew his underwriting, was very comfortable with it, as well as his asset management capabilities. We got together. Actually, it was over beers at a Mexican restaurant that we came up with the idea, and Nuvo was born. Just this would have been the beginning of last year.
Wow, that's awesome. So how do you go about finding new opportunities? Is it by the conference circuit or
A lot
existing
of it,
relationships?
yeah, a lot of it is personal relationship. Underwrote a lot of deals in 2020, 21, 22. Some of them are coming from deals that we previously looked at in my old shop. And then a lot of it is just word of mouth. So if we are able to work out something on one deal, there might be, as you alluded to earlier, multiple GPs on any given deal, and they might be involved in another deal somewhere else. And so once people figure out or realize that we're trying to help the situation out, it usually spreads. So it's all been primarily word of mouth.
That's great. Have you found that a deal, what are the instances where you just haven't been able to come to terms? Is it that the sponsor is unwilling to admit defeat yet, or other things?
That's happened before where, and to their credit too. So I just want to say, in the majority of conversations, the primary concern of whichever seller or sponsor we're talking to is their own investors. They don't want to lose their investors' money, and they're doing everything they can to save it. So with that being said, if they have a little bit of time left, if they're 6 months away, 8 months away from that debt maturity, or whenever they need that capital, I understand why they would wait and make sure there's not a better option out there. Other cases, so that's addressing you're not admitting defeat. It's not necessarily not admitting defeat. It's just, well, let's wait. We have a little bit of time, and let's see if there's a better solution. The other times it doesn't work is, quite frankly, when the purchase price or the value that we would assign to the property is worth less than the loan balance. So we can help as long as the loan balance is a good acquisition price. If it's below, that's where it gets tricky, because lenders aren't necessarily willing to take a haircut on the loans right now.
Interesting. I'm just thinking about deals. Interesting. When is the best time for you guys to come into a deal? Is it when there's 2 months left and they have a gun to their head, or?
Fortunately, that's what we're seeing. The earlier, the better. But as I mentioned earlier, they're in a lot of circumstances just waiting and doing anything they can to try to save the investors' money. And so it's not until there's only a couple months left from them being, say, foreclosed on, that we're getting involved, because they're thinking, okay, all right, let's just sell it. Let's not have a foreclosure on our record. And let's see if we can get some of this capital back in 3 years, 5 years when Nuvo sells. So it's usually a high pressure, short time frame situation for us.
So it's an all hands on deck sort of thing whenever you get something in and you get close on the value, and then you're like, okay, let's figure this out.
That's right. Yeah, we usually don't have the luxury of time. We've had a few that are forward thinking, if you will, that have come to us with 6 months, 8 months left, and then there's not as much pressure to get something done right away. But most of the time, there's not too much time left before something needs to happen.
So you and I are sitting on similar sides of the table, but different options. Why have, and I mean that because I'm selling deals and you're rescuing them. Why would somebody not opt for just a straight sale and go for a deal with you guys?
A lot of times it's because the straight sale or transaction, if you listed it, would be very close to the loan balance anyways. If you can get more than that, that's great. But we're actually viewing this as a partnership with the sellers. So nobody knows more about the property and its problems than whoever has owned that for the last 2 years. They've faced all the struggles. They know what's going on, and being able to get that information from them is very helpful for us going forward. And the better that Nuvo does, the more, or the better that the seller does too. We've tried to align interests to where, okay, we're not necessarily looking at this as selling the deal. We're restructuring it, and we're now a partner in this new deal going forward. So the benefit to that is they're getting a piece of what Nuvo would have made for the carry on the back end as one of our LPs, basically. So there's avoiding foreclosure, a quick transaction timeline, and the opportunity to actually get some money back in the future. All things that are better than a traditional listing.
Yeah. Do you ever have to claw back equity from sponsors, or you flip them from a GP into an LP position? Like, you know what I mean? Do you ever have to be like, guys, you took too fat of an acquisition fee up front. We're going to need some of that back. Or is maybe that just gets worked out the new acquisition?
Yeah, no, we don't claw anything back. The idea is that we try to make it as simple as possible for the sellers to just, okay, we'll take it from here. You'll participate in the upside, but we're actively managing these now. Um, so our investors are family offices and institutions, and that's why we have to take control of the property. There's no passive investing on our end.
That was going to be that was going to be my next question. Where does your capital come from? So that's your value prop. In addition to being the rescue capital is, hey, we're going to take this over. And do you retain the existing sponsors like a consultant?
So the existing entity stays a part of our deal as a
Mhm.
passive investor, if you will. So the structure that was previously set up when they acquired remains the same. When distributions are paid out, it goes to the entity, and then that flows down the waterfall model, whatever they had for distribution set up initially. So they get to keep their entire structure intact. And then it's more of a it's not in an official capacity that they're a consultant or anything like that. It's more of a, hey, if we all want this to work, we need to have an open dialogue.
Yeah.
Um, and so it's much more casual, if you will, that relationship, but everyone's on the same page as far as what we want to happen.
Yeah. Let's all row the boat in the same direction.
Yeah.
And like you said, they want to do everything they can to, preserve their investors' capital. So they're
Sure.
inclined to want to do that. That's great. You're providing a service, a needed service, it sounds like.
We
So,
like to think so. We all came from private equity prior to this. We've been in the hedge fund space and alternative asset managers. And quite frankly, there's a lot of just I don't want to say greedy, but just people that are out to make money for themselves and don't really care about much else. We're trying to make money, but we're trying to do it by actually providing a service and helping people as opposed to just a vulture fund or something like that. In fact, our name Nuvo, Nuvo, actually stands for never underestimate valuing others, which is something we try to live by when we're acquiring these properties. It's somebody got into a bad situation, we have a chance to help and we can make money doing it.
yeah. Do you have some like a highlight reel of good stories that have worked out so far?
So we started this at the beginning of the year. We've got a couple under contract right now. Haven't closed though, because we spent all of the better part of last year and into this year basically raising capital and preparing our family office and institutional investors for the opportunity that's coming. Part of that was underwriting deals without the intent. We weren't sure how bad it was going to get, when the deals were going to look good, when we felt confident enough that, okay, we can act on this. We've underwritten close to $6 billion of distressed multifamily in the last year in conjunction with underwriting, raising, and showing those opportunities to potential investors and how they would work. And now I'm happy to say that everyone's ready to move. The capital is ready. They feel confident that we have a grasp of the extent of the situation. And now's a time that we can actually start deploying.
Hmm. What are some of the most common mistakes you'll see in sponsors, pro formas, or underwriting when you get it?
So let's just say we're looking at a pro forma or OM going back 2 years. A lot of times the entry cap rate was very low, like sub 4%. And so that's in trouble from the beginning because it's going to be hard. It would have been hard for cap rates to compress even more, even without rate hikes. And then the just rent growth assumptions in general, which drive everything. Underestimating expenses and overestimating the revenue or cash flow is probably some combination of those things. The IRR that was backed into, let's just call it mid-teens IRR, was based off of a low exit cap, and that's driving the rent. Whether you do it with rent expenses or the cap, it's just not being conservative enough.
It was too much value add through Excel to try and get the deal.
Yeah, so the value add plan was well and good, and maybe you can drive the rents there, but then you're also assuming that you're going to exit at a 4 cap. And you change that to a 6 cap, and the deal doesn't even have a positive IRR anymore. Stuff like that, which is what we saw a lot when I was at the fund of funds. It was play around with the exit cap and see what the returns look like then. And a lot of those assumptions were just aggressive.
That's a good question. How are you underwriting exit caps?
Right now, as in today,
Yeah.
We're around a 6 or a 7, depending on the asset class and location. So we're not assuming any compression really.
Hmm.
And if the deal still looks good that way, we're good. Maybe a more traditional approach that I know a lot of shops do is some spread over whatever the forward curve is showing you. If you think interest rates are going to be 4% in 3 to 5 years, then you tack on 150 basis points to that and back into your exit cap. We're just not underwriting as if interest rates are going to come down. So that's basically why our exit cap assumption is where it is. If something happens, and we've already seen the Fed pull back on how many rate cuts they're going to have this year. Now they're saying 3 as of this week, but I wouldn't be surprised if it ends up being 1 or 2 this year.
Yeah, I'm skeptical if they'll actually make any cuts personally, but
Yep, and there's a growing cohort now that's talking about hikes next year. So
geez Louise, I hope not. Just keep it even.
yeah, I'm not in that camp yet, but there's a couple of compelling arguments for why that could happen. Anyways, all that being said, that's why we're still assuming a 6-7 cap rate.
Yeah. What are those arguments to potentially have a rate increase next year?
It's basically that the population that is spending money, actually spending money, is not so affected by inflation. Lowering interest rates is going to create more inflation in the market, which is actually the Fed's worst nightmare. They would much rather have well, I shouldn't say rather, they're more scared of inflation taking off than they are causing a recession. So they have to be darn sure that inflation is under wraps before they start cutting. And I feel like the announcement this past week was a little bit premature and announcing 3 cuts, because it's just the data is not fully supporting that inflation is under control right now. And
Yeah.
if you start easing conditions right now, again, it's the folks with money that aren't affected by inflation that are doing most of the spending. So they won't.
Who is that population? How'd they define that?
Oh, I wish I could remember this.
Putting you on the spot, sorry.
I want to say it's the top 50% of income earners actually do, I believe it's 84% of the spending. So it's a pretty significant, if that's not the exact one, maybe we can edit that, but
That's all right. It's close enough.
I've got that written down somewhere on my computer because it was so impactful. That was actually from Jim Bianco. He does his own research, Bianco Research.
Okay.
So you can check out him and you'll find the exact stat.
Jim Bianco, I'll look him up. Yeah, I don't know. I am not an economist. I, I just hope that they would keep things level. Just keep it even. You don't have to get crazy. Just keep it, because last year it was tough. We underwrote 200 deals and we saw the average spread between buyer and seller expectations about 20%. And that was like every time we would go do a proposal, there was a 20% gap between our optimistic and their, yeah, this is our bottom line. And it's, oh my gosh, like how do you can't bridge that really?
Right.
So that was a challenge. I remember one, it was a 30% spread. And I was like, sir, how do you get to your pricing? He's, yeah, it's a 4.65 cap. I was like, how? Like it didn't have assumable debt. I was like, what world are you living in? So that was fun.
Yeah, we're actually working on we're calling it the Nouveau Index, but it's essentially of the properties that we've underwritten that aren't on the market. And then we're basically going to publish the discount that property should be trading at right now based compared to the previous transaction value. So don't have that ready yet, but we've got an awful lot of data with 6 billion as of now underwritten that's feeding into that model. So we hope it'll be very helpful for our investors and may eventually make it public too. But the disconnect is the reason I brought this up is the disconnect is so wide right now that we figure, okay, we have to be able to tell our investors where it should be at right now, because you get very mixed signals from whether you're a buyer or a seller.
Yeah. Yeah. When we're valuing a deal, we try not to, buy a listing in quotes, because that doesn't do anybody any good. What are the returns that you're looking for when you're evaluating a deal? Are you IRR driven, cash on cash within a certain amount of years? What are those look like?
It depends on the investor. So some are much more return focused but I'll say that with institutions and family offices, the stabilized yield on cost is probably the single biggest one, and then followed by maybe cash on cash and then IRR. So the IRR needs to be mid-teens-ish, but then the others are usually based off of some delta or spread from whatever benchmark rate they're choosing. So call it the 10-year plus 150, 10-year plus 175, 10-year plus 2. That's what they want for their stabilized yield.
So the stabilized yield on cost is the cash on cash once the value creation plan has been implemented.
It's the stabilized NOI
Yeah.
divided by your total cost of the project.
Oh, I see. Yeah.
So it's
So
a
that
very,
includes, yeah.
it takes kind of everything into account and gives you one number that you can compare alternative investments to.
Interesting. So would that be the stabilized, it's the cash, is it the cash flow over the, I guess, the down payment plus the value add funds that you've put in and any
That's
carry?
right, your total cost.
Yeah. Okay. That makes sense. And so
So
that's,
if you could spend that money on something else, so you can compare investments pretty quickly, and a lot of our investors are comparing a lot of different investments, and it's a good way to, or different asset classes, I should say, and it's a good way for them to compare. That's been tricky, and that's where the IRR has been such a focus for the last 5 years. Now, I'm not sure if you're seeing this, but we're seeing AAR an awful lot now, and I don't remember seeing it much at
average
all.
annual return.
Yeah, so not
Yeah.
taking into account time value of money or a discount rate, but we're seeing it more and more, and by default AAR is higher than IRR, and so I think that's where investors are trying to make the investment sound a little bit better, because they're used to seeing mid-teens IRR for the last 5-10 years, and now it's a mid-teens AAR.
Yeah. And that can be easily manipulated on the back end too with the juice of a sale.
Yeah.
But just the same way that an IRR can. But
Sure.
yeah, I was at a discussion last week with a couple of syndicators and at various stages in their career, and they were talking about the same thing. How they'd seen a lot of the ARR metrics out there. Yeah, just an interesting thing.
It's anecdotal. It's just from the deals that I've seen, but I've seen it enough now to know that it's definitely something that's happening, where IRR is moving to the side and AAR is coming in for new pitch decks.
Interesting. This is fascinating. It's a sign of the times, just a changing market, and you guys are adapting to it. So cheers to you.
Hopefully we're in the right place at the right time, and can actually do some good and help our investors too. But it is definitely an interesting time.
Mhm.
Unprecedented in my adult life. I think most of us haven't lived through something quite like this before. I was just starting my career at the last cycle. Things have been very good for a lot of people for over a decade now. It'll be interesting to see how everyone adapts to what's coming next.
Yeah. Yeah. I was just starting back in '08 as well. So it was like, I'm here for the party. And then they're like, no, the party's over. You missed it. We're all hungover now. I was like, oh, okay.
Yeah.
That's great. So do you work with, I guess, if people want to get in touch with you, I guess it's existing sponsors, brokers that maybe want to refer you a deal. Do you work with them?
Yeah, we're happy to, especially if we can get a look at stuff that's not quite on the market yet, and somebody's putting out feelers, because quite frankly, the structure still works if there's a broker involved. We can still help recoup some of the lost capital to the seller. And when we come out of all of this, whatever this is and however long it lasts, we still need great broker relationships, and we plan on being in this space for a long time. So understand it's not been an easy time for anyone, including brokers. When there aren't transactions happening, it's tough. So
It's tough. Yeah.
we do it.
Well, that's great. If people want to get in touch with you to talk to you about a deal, what is the best way to get in touch with you, Brian?
Probably just reaching out on LinkedIn. I'm Brian Underdahl. I've got a LinkedIn page. You can go to our Nuvo page on LinkedIn as well. We've got like a landing page for our website just to subscribe to our research and newsletter, and we can reach out through there if you do the contact. We don't, I think I mentioned this, but we're not trying to attract accredited investors or retail investors. You're not going to be sold anything, but would love for somebody to subscribe to our research as well.
I'm going to subscribe. I'm curious about what you guys are doing.
The research comes out about once a month, but it's a weekly newsletter. So once a month, I'll put in something special. Usually look at interesting correlations in macroeconomics and sometimes within an actual MSA. But just it's like a fun project that points out some stuff that maybe isn't immediately obvious without digging into the numbers.
Yep. That's awesome. All right. Brian, thank you so much for joining us today, and I'm sure we'll be in touch.
Thank you. Yeah, I'm looking forward to talking offline too, Stash. I really appreciate it.